Picture waking up on an ordinary Tuesday, grabbing your coffee, tapping your card at the register like you've done 10,000 times before, and watching the screen freeze instead of beep. Then your phone buzzes with a headline that makes your stomach drop. Every ATM in the country, all at once, has stopped dispensing cash. Not one bank, not one region, but the entire national network gone dark at the same moment. This isn't a movie plot. It's a scenario financial regulators actually study. And once you understand why they take it so seriously, you'll never look at the little plastic card in your wallet the same way again. Meet Marcus, a 38-year-old warehouse supervisor living just outside Atlanta, Georgia. Like most working Americans, Marcus hasn't carried more than a few dollars in cash for years. His paycheck lands by direct deposit, his groceries go on a debit card, his rent gets paid through an app, and he genuinely can't remember the last time he stepped inside an actual bank branch. So when his banking app flashes an error message that morning, his first instinct isn't panic, it's mild annoyance, the same reaction he'd have to a slow Wi-Fi connection. He assumes it's a glitch that will fix itself in 20 minutes. It doesn't. By mid-morning, news alerts confirm what feels almost unbelievable. A coordinated technical failure has knocked out ATM access across the entire United States, and officials are warning the disruption could stretch on for days, maybe longer. This isn't as far-fetched as it sounds. It's actually happened before, just never at this scale. Back in 2011, Wells Fargo suffered one of the largest single-bank ATM outages in American history, when roughly 9,500 machines across the country went dark for several hours after what the bank vaguely described as an internal systems issue. Customers stood in front of machines flashing out of service messages with absolutely no explanation, and it took the bank nearly 18 hours to even publicly acknowledge what was happening, let alone explain what customers should do instead. More recently, in the spring of 2025, a third-party company that serviced roughly 2,000 ATMs across 12 states abruptly shut down its operations without warning, citing what it vaguely called unforeseen business circumstances. Overnight, dozens of credit unions across Tennessee, Kentucky, Mississippi, and beyond found their machines going dark or running out of cash. And in some cases, the vendor held the only keys and service codes needed to even open the machines, meaning credit unions couldn't refill their own ATMs or bring in a new provider fast enough to matter. For members in rural towns, this wasn't a minor inconvenience. It meant no nearby access to physical cash at all. And in 2024, thousands of Bank of America customers watched their account balances display as flat zero, with no way to withdraw funds or process any transaction. In a glitch the bank later called fully resolved but never fully explained. These aren't obscure footnotes buried in financial history. They're recent documented reminders that the infrastructure connecting your money to your actual life is far more fragile than it appears on the surface. Marcus starts to feel the outage in ways he never expected. His favorite lunch spot near the warehouse switches to a cash-only sign taped to the door because their card processing system keeps timing out under what employees assume is unusually heavy nationwide traffic. This exact scenario has happened before on a smaller scale. In 2021, a payment processing company called Fiserv suffered a system failure that knocked out card payments at major chains across the country, including McDonald's and IKEA locations, forcing them to accept cash only for the several hours it took engineers to restore service. It's a strange kind of vulnerability that most people never think about. The idea that a single company most customers have never heard of sits quietly in the background of an enormous share of the payments happening every single day. And when that one company stumbles, the ripple effects show up at cash registers hundreds of miles away almost instantly. Marcus starts digging through his wallet that evening and realizes he has exactly $6 in cash to his name. He's not alone in this. Recent Federal Reserve research on how Americans actually pay for things found that consumers made an average of 6 cash payments a month in 2025, down sharply from 14 payments a month back in 2016, meaning cash use has been quietly shrinking for a decade, even as it never fully disappeared. Roughly 76% of people still say they carry some cash in their pocket day to day, but the amount has dropped considerably, and the reliance on cash now skews heavily toward specific groups, rural residents, people over 55, and households earning under $25,000 a year, all of whom depend on physical currency far more heavily than the country as a whole. For everyone else, cash has quietly become a backup system. Nobody actually maintains anymore. The emergency parachute nobody bothered to repack. On the second day of the outage, something even stranger starts happening. Grocery store lines grow longer as shoppers try to get cash back at checkout while that option is still available. Gas stations start rationing how much fuel each customer can pump as anxious drivers top off their tanks just in case. And pharmacies quietly start prioritizing customers who can pay in cash for time-sensitive prescriptions, since some of their card terminals are experiencing intermittent failures tied to the same nationwide strain. None of this happens because the economy has actually stopped functioning. Every paycheck is still being deposited exactly on schedule. Every dollar in every account still exists exactly as it did before the outage began. What's actually failing is access, the fragile, invisible bridge connecting the numbers on a screen to something a person can actually use to buy food. This distinction matters enormously, and it's precisely the point financial regulators have been trying to hammer home for years without much success, because most people never think about it until the bridge itself collapses. Meanwhile, behind the scenes, cybersecurity teams across the country are working through every possible explanation for what triggered the outage in the first place. This particular fear, a large-scale cyber attack targeting the machinery of the financial system, isn't hypothetical anxiety. It's a documented and growing concern among the institutions responsible for keeping the system running. Financial services now rank among the most heavily targeted sectors for cyber attacks anywhere in the economy, accounting for a massive share of all reported breach activity across North America and recent threat intelligence reports. Ransomware, distributed denial of service attacks designed purely to overwhelm and disable systems, and increasingly sophisticated attacks that exploit vulnerabilities in third-party vendors rather than the banks themselves, have all become recurring features of the financial sector's threat landscape. One especially unsettling detail from recent industry analysis is that a single compromised managed service provider was able to cascade its way into more than 30 different financial institutions at once, exposing the personal data of over 1 million customers through a single point of failure buried deep in the supply chain that almost nobody outside the industry ever thinks about. This is exactly the nightmare scenario Marcus's outage represents. Not necessarily a single bank failing, but a shared piece of critical plumbing, somewhere upstream breaking in a way that takes down dozens or even hundreds of institutions simultaneously. Because in modern banking, an enormous number of seemingly separate competing banks all quietly rely on the exact same small handful of technology vendors behind the scenes. By day 3, rural communities start feeling the disruption far more acutely than big cities do. This tracks with everything researchers already know about how unevenly cash dependency is distributed across the country. Rural households have historically relied on cash as their primary payment method, at nearly double the rate of urban households, largely because they have fewer bank branches nearby, spottier broadband and cellular coverage to support digital payments, and far fewer backup options if one payment channel goes down. Elderly residents face a similar squeeze, and while more seniors are gradually adopting mobile payments than ever before, with usage among people over 65 climbing noticeably over the past decade, older Americans, as a group, remain disproportionately reliant on cash and far less equipped to suddenly pivot to an unfamiliar digital workaround in the middle of a crisis they didn't see coming. This is the uncomfortable truth sitting underneath every conversation about a fully cashless future. It sounds sleek and modern right up until the exact moment the technology it depends on stumbles, and then it becomes painfully clear that convenience and resilience are not the same thing, and pursuing one aggressively can actually come at the expense of the other. Sweden offers a genuinely useful preview of where this trend eventually leads, since the country now conducts somewhere around 90% of its transactions digitally and has moved further toward true cashlessness than almost anywhere else on Earth. But even there, officials have started publicly urging citizens to keep some physical cash on hand specifically because of exactly this kind of vulnerability. The recognition that a system built entirely on interconnected digital infrastructure is, by definition, only as strong as its weakest and most invisible link. Marcus's employer sends out a company-wide email on day 3 reminding everyone that direct deposits are continuing completely normally despite the chaos, which is technically reassuring, but doesn't solve his immediate problem of having almost no accessible cash and a refrigerator that's starting to look sparse. He starts leaning harder on peer-to-peer payment apps to split costs with roommates and coworkers, only to discover that these apps have their own well-documented history of buckling under pressure. Major payment apps have experienced their own outages entirely independent of the banking system itself, sometimes tied to surging transaction volume during high demand periods, and sometimes to plain old internal system failures that have nothing to do with any bank at all. During one widely reported outage, users described watching a transfer show as successfully processed on their screen while the money simply never arrived, leaving them stranded at exactly the moment they needed funds most urgently. Unlike a traditional bank account, this web page or app you're using to move money often has no FDIC insurance sitting behind it protecting your access. And during outages like these, speed and convenience get exposed as the wrong things to have optimized for when what people actually needed was redundancy. This is genuinely the core lesson buried inside Marcus's nightmare week. That modern financial life has quietly been built on top of an ever-narrowing stack of digital systems, all of them assumed to be permanently available, none of them actually guaranteed to be. The Federal Emergency Management Agency has understood this risk for a very long time. which is exactly why every official disaster preparedness guide the agency publishes explicitly recommends keeping a modest amount of physical cash, ideally in small denominations, stored somewhere safe and easily accessible at home, specifically because ATMs and credit card systems may simply not work during a disaster when people urgently need to purchase fuel, food, or emergency supplies. This isn't fringe advice from doomsday preppers. It's the official mainstream position of the government agency, whose entire job is studying how disasters actually unfold in the real world. The FDIC's own internal review of the aftermath of Hurricane Katrina drew the exact same conclusion in blunt, direct language, explicitly warning financial institutions to be prepared to operate in what they called a cash-only environment, since power and telecommunications outages can disrupt every single electronic form of payment simultaneously, leaving both customers and employees needing unexpectedly large amounts of physical currency just to get through the following days. During Katrina, some bank branches and ATMs sat underwater for weeks at a stretch. Mail service was disrupted for months across parts of the Gulf Coast, and institutions that hadn't specifically planned for a cash-heavy recovery scrambled desperately to improvise. That lesson has repeated itself again and again in the 2 decades since, most recently during Hurricanes Helene and Milton, when millions of customers across the southeastern United States lost power for well over 2 weeks in some areas, taking card readers, cell towers, and banking infrastructure down right alongside the electrical grid itself, and leaving families who had prepared with even a small cash reserve noticeably better positioned than neighbors who had assumed their phone and their debit card would always be enough. This kind of vulnerability isn't limited to the United States either, and looking abroad makes the underlying fragility even clearer. Back in June of 2018, a hardware failure inside Visa's European network triggered an outage lasting roughly 10 hours, and during that window alone, about 5.2 million card transactions failed to process, with roughly 2.4 million of those failures happening in the United Kingdom during peak shopping hours. Restaurants couldn't close out tabs, grocery stores couldn't finish checkouts, and public transit systems that had gone almost entirely cashless found themselves suddenly unable to let people pay for a ride, all because of a single hardware fault buried somewhere deep inside a network most cardholders had never once thought about. It wasn't caused by hackers, and it wasn't caused by any bank doing something wrong. It was simply a physical component failing at exactly the wrong layer of an enormously complex, tightly interconnected system, and the entire continent felt it within minutes. Marcus starts to realize that the outage he's living through fits into a much larger, much more troubling pattern that cybersecurity researchers have been documenting with growing urgency. Recent industry threat reports tracking the financial sector describe a genuinely alarming trend. Incidents targeting finance companies rose by more than 75% in just the first quarter of this year, compared to the same period 1 year earlier, and the number of critical, high-severity vulnerabilities identified across the vendors that banks depend on jumped from just 15 to 73 in a single 12-month stretch. More than half of the core financial technology vendors examined in one recent audit were found to be carrying at least one unpatched vulnerability serious enough to appear on a federal government list of flaws actively being exploited by attackers in the wild. This matters enormously because of how modern banking is actually architected behind the scenes. Almost no bank builds its own core technology entirely from scratch anymore. Instead, dozens or even hundreds of competing banks all quietly lean on the exact same small handful of outside technology vendors to handle things like ATM networks, online banking portals, and payment processing pipelines. It's efficient, it's cost-effective, and it works beautifully right up until one of those shared vendors gets compromised or simply fails, at which point the damage doesn't stay contained to a single institution. It cascades outward across every bank that happened to be relying on that same piece of shared infrastructure at the same time. Marcus's fictional nationwide outage is really just this exact dynamic playing out at the largest possible scale, a single upstream failure rippling downstream into millions of ordinary mornings all at once. There's a psychological layer to all of this that becomes impossible to ignore by day 4 of the crisis. Marcus notices that even people who technically still have money, whose direct deposits are landing exactly on schedule and whose account balances remain completely untouched, are behaving as though they've actually lost something. This isn't irrational panic, it's a fairly predictable response to what researchers who study financial behavior sometimes call an access shock, the sudden disorienting realization that having money and being able to use money are not actually the same thing at all. Something similar played out during the collapse of a well-known regional bank in the spring of 2023, when a bank run driven partly by old-fashioned panic and partly by real-time social media speculation caused the institution to lose an enormous share of its deposits within a single trading day, faster than almost any bank failure in American history. Nearly 90% of the deposits held at that bank exceeded the standard $250,000 federal insurance limit, and even though regulators ultimately made an emergency decision to guarantee all deposits at that particular institution, rather than let uninsured customers absorb losses, they were explicit that this was a one-time intervention, rather than a permanent new policy going forward. The lesson embedded in that episode isn't really about the size of any single account balance. It's about how quickly confidence itself can become the scarcest resource in a financial system the moment people start doubting whether they can actually access what's theirs. Marcus's ATM crisis triggers a milder, more universal version of that exact same psychological reaction. Hoarding behavior, longer lines, and the instinctive urge to convert invisible digital numbers into something tangible he can physically hold, even though nothing about his actual account balance has changed even slightly. By the middle of the week, financial advisors and consumer protection experts start appearing across news broadcasts offering the same steady, repeated advice, and it largely echoes what government agencies have been quietly recommending for years without much public attention. The Emergency Financial First Aid Kit, a joint publication from FEMA and the nonprofit Operation HOPE, specifically recommends that households keep some cash stored in the same safe location as their essential financial documents. Precisely so, it remains accessible even if the power is out, and the internet connection everyone assumes will always be there simply isn't. Other widely circulated disaster preparedness guides go a step further, suggesting households keep a minimum of roughly 5 days' worth of small denomination bills on hand, since large bills become genuinely difficult to spend once stores start running short on change during a crisis, and dividing that cash across a few different hiding spots, rather than one single location, provides an extra layer of protection in case anyone's stash gets lost, damaged, or stolen. None of this advice stems from mistrust of banks or some deep suspicion of modern digital payment technology. It stems from decades of accumulated, well-documented experience with exactly the kind of disruption Marcus is currently living through. Hurricanes, ice storms, regional power failures, and vendor collapses that have repeatedly demonstrated the same basic truth again and again, that redundancy costs almost nothing to maintain, but can matter enormously the 1 week it's actually needed. On the fifth evening, Marcus's neighbor, an elderly woman named Ruth, who has lived on the same street for nearly 30 years, mentions almost casually that she hasn't felt the disruption nearly as much as everyone around her, and it stops him in his tracks. Ruth still keeps a modest amount of cash tucked inside a kitchen drawer, a habit she picked up decades ago and simply never abandoned even as the rest of the world shifted toward tapping plastic cards and phones at every register. She isn't a prepper. She isn't anxious about some looming financial collapse. She just quietly maintained one small layer of redundancy that most of her younger neighbors had long since let go of entirely. That conversation reframes the entire week for Marcus. This was never really a story about a catastrophic system failure destroying the economy. It was a story about the widening gap between how modern life is designed to work under ideal conditions and how it actually behaves under even mild, temporary stress, and about how a small, almost forgotten habit like Ruth's kitchen drawer stash can quietly bridge that exact gap when it matters most. And it's worth pausing on because it reveals something important about how the financial system is actually designed to behave under stress. Unlike a single point of failure, modern banking relies on several genuinely separate rails running in parallel: cash and physical circulation, debit and credit networks, direct deposit and payroll systems, wire transfers, and increasingly popular peer-to-peer apps. And when one of these rails goes down, the others typically keep functioning, even if imperfectly. This redundancy is precisely why, historically, no insured depositor in the United States has ever actually lost money due to a bank failure, even during the most chaotic collapses in modern banking history, because deposit insurance and backup payment channels exist as deliberate safety nets built specifically to prevent exactly the kind of cascading collapse that Marcus briefly feared was unfolding around him. Officials at the Federal Reserve who study consumer payment habits describe cash itself in almost identical terms, noting that even as its everyday use keeps gradually declining, the public continues to view it as a dependable fallback specifically because it requires no electricity, no internet connection, and no functioning app to actually spend. That resilience is exactly why cash refuses to disappear completely, no matter how aggressively digital payments keep expanding their share of daily transactions year after year. On the sixth day, engineers finally begin restoring ATM access region by region, starting with major metropolitan hubs, before gradually working outward towards smaller and more rural communities, which naturally means the communities that were already struggling the most throughout the outage are also the last ones to see their access fully restored. Long lines begin dissolving within hours of each region coming back online, and by the seventh morning, the national network is fully operational again, machines humming back to life exactly as if nothing had happened at all. Marcus withdraws a modest amount of cash that morning, not because he genuinely expects a repeat crisis tomorrow, but because the week left him with a very different relationship to something he'd stopped thinking about entirely: Looking back, he realizes the crisis was never really about ATMs specifically. It was about how deeply modern daily life has come to depend on invisible, interconnected technology that almost nobody actively thinks about until the precise moment it stops working. A machine bolted to the outside wall of a grocery store, one most people walk past without a second glance, had quietly become a genuinely essential piece of everyday infrastructure, and its sudden temporary absence revealed just how tightly banks, technology vendors, businesses, and ordinary consumers are all wired together into a single dependent system. In the end, the broader economy survived completely intact. The banking system itself remained fundamentally stable throughout, and public confidence gradually returned as machines came back online one region at a time. But the week left behind a lesson that applies just as much to a single household budget as it does to the entire national payment system, that convenience is remarkably easy to take completely for granted, right up until the moment it disappears without warning. In a world where money increasingly moves with nothing more than a tap of a screen, genuine resilience rarely comes from perfectly predicting the next disruption before it happens. It comes from building in just enough redundancy, a little bit of cash tucked away, a backup plan that doesn't depend entirely on one single app or one single machine working flawlessly every single day, so that when the unexpected inevitably does happen, it becomes a manageable inconvenience instead of a genuine crisis. The people who came through that week with the least amount of stress weren't the ones who had predicted a nationwide ATM failure specifically. They were simply the ones who had never fully bet everything on a system they couldn't see, couldn't control, and as it turned out, couldn't fully rely on either. There's one more layer to this story worth sitting with, because it explains why this kind of disruption never lands evenly across the population, and why the conversation about cash versus digital payments isn't purely academic for millions of Americans. Federal Reserve Survey data shows that roughly 6% of American adults remain entirely unbanked, meaning they have no checking, savings, or money market account of any kind, and that rate climbs dramatically among lower-income households, with something like 22% of adults earning under $25,000 a year falling into that category compared to just 1% of adults earning six figures or more. For these households, cash was never a nostalgic backup plan or an emergency preparedness afterthought. It's the primary and often the only functioning payment method available to them every single day, which means a nationwide disruption to cash access doesn't create a mild inconvenience for this group the way it did for Marcus. It strikes at the very foundation of how they participate in the economy at all. This uneven impact is exactly why consumer advocates and banking regulators have pushed back so consistently against the idea of a fully cashless retail environment, and why a number of states and cities across the country have actually passed laws requiring brick and mortar businesses to continue accepting physical cash, even as card and mobile payments keep climbing toward the overwhelming majority of daily transactions. It's a quiet but important reminder that resilience isn't just a personal finance strategy for individual households. It's also a structural design question about how an entire payment system should be built so that no single failure, whether it's a hardware glitch, a cyber attack, a natural disaster, or a vendor simply going out of business overnight, ends up locking out the people who can least afford to be locked out. As Marcus's week finally winds down and the machines hum back to life across the country one region at a time, he finds himself thinking less about the outage itself and more about the quiet lessons sitting underneath it. Modern financial convenience isn't an illusion. The vast majority of digital transactions really do work exactly as promised, day after day, without a single hiccup, for years at a stretch. But convenience and resilience aren't the same property. And building an entire financial life on top of a single rail, whether that rail is a debit card, a banking app, or a peer-to-peer payment service, means placing a great deal of faith in infrastructure that was never actually designed to be perfect, only to be reliable most of the time. Most of the time turns out to be an entirely different promise than always. And the difference between those two words is precisely what an entire nation discovered over the course of one very long week.